Welcome to Principles of Accounting 2. I'm your instructor, Joe Giordano. We are trying today for the very first time, first attempt, of using screencasting software. This could go very well. It could be a complete disaster. Either way, you should be very successful in this course because we've got lots of various tools for you to use and to help. And of course, we're always available over here at Metro State if you do need to come in or do some sort of other fancy web type correspondence, emails, who knows. So I'm going to go ahead and pull up the first presentation, which is basically chapter 1 in the textbook. It's really an overview of managerial accounting. There's some product and period costs, and then we also talk about just-in-time inventory, a little bit of Sarbanes-Oxley, this, little that, just get you oriented for the semester. One of the first things we really talk about in this textbook is the differences between financial and managerial accounting. If this was a live class, I'd start out with a lecture that says, forget everything you ever learned in Principles 1, and everyone will say, we already have, and everybody laughs. But since I'm just talking to a computer, I don't know how that'll go over, so I won't say that. In Principles 2010, your first accounting class, that really primarily dealt with SEC reporting requirements. They're on financial statements everywhere. It's for public companies. It's they're tremendous, really important, but they don't really help people make decisions inside a company. So this managerial accounting, a lot of people like it better because it doesn't matter what your background is, what your future holds. You'll be able to use most of the stuff in this book to make decisions. Marketing people do managerial accounting all the time. Salespeople do managerial accounting all the time. Small business owners are always doing this stuff. So it's really primarily dealing with things that you'll use for the rest of your life. Doesn't mean you'll love it, but most people like it better than 2010. If you're an accounting major, this is going to correlate very highly with your cost accounting, ACC 3300 course, and your 2010 would correlate a lot more closely with your intermediate 1 and 2 courses. So really, this table here, is it a table? Yeah, let's call it a table for today. We're really depicting the differences between financial and managerial accounting. Really the users with financial is external, right? Think like the SEC, investors. You go to the SEC website, you pull up the Edgar database, and you look at Best Buy's numbers and decide whether or not you want to buy stock. You're looking at financial accounting. That would be very regulated because you don't want Best Buy reporting differently than, I'm trying to think of their competitor, Circuit City, they're gone, but another type of electronic device. Aggregation, of course, that means what level of detail. If you're looking at a company like GE, large company, lots of different products, you're basically, their financial statement, their revenue is for the entire company. Also with financial, you're looking at periodic reporting every quarter. They come out with a 10Q, every year they come out with an annual report, that sort of thing. Also with financial, they say factual, and I always say haha because I teach a lot of fraud and stuff, but they should be based on facts, meaning things that have happened in the past. With managerial accounting, it's really, the users are everyone inside a company. So if you're investing in a company, you don't have access to this stuff. You'd like to have access to it, but that's called insider trading. The purpose is usually for business folks to make better business decisions. And it could be aggregated at a department level. Hey, how's our Phoenix office doing this week? That would be the kind of the question. How do we get more sales in the southwestern region? Those are some of the questions that you would ask in a managerial accounting setting. Reporting frequency, they say as needed, continuous. Most of these things come out when you are 5 o'clock, you're ready to go home, your boss comes in and says, hey, I need this right now before you go home. That's how a lot of this stuff happens. It really is depending on the needs of the business at the moment. Now the information characteristics are interesting because there we talk about estimates. Estimates meaning these are everything, pretty much everything we deal with in this class hasn't happened yet. It's things that are going to happen in the future. So we don't know for certain what happened in the future because it hasn't happened yet, unless you're like some sort of weird Bill and Ted's Excellent Adventure type movie. So we have to estimate what's going to happen. What are our future sales, that sort of thing. In the time horizon, we are looking at past data, present data, future data. All right, I'm going to try to take a glass of water now while we digest that. Delicious. Okay, so quick review of the financial statements. We have a couple things going on here. First, you have your balance sheet. If you remember your balance sheet, the big thing with that is it has to balance. And that's your balance sheet equation, which, hey, I'm going to try to use my cursor. Assets should equal liabilities and shareholders' equities. Depending on when you've taken Principles 1, you may know what a debit and credit is. You may have never heard of it before. For this class this semester, we'll use them a little bit in Chapter 11, but you can slide by. I'll give you a very high-level overview of it right now, but if it freaks you out, don't worry about it. But really, most of what we're using in this class are something called the horizontal financial statements. Your typical balance sheet accounts for this class. If you remember 2010, there was about 1 billion accounts on the balance sheet. Lots of detail, lots of contra accounts. Right here, these and these over here are more or less, there might be another one here and there, but these are pretty much all of the accounts we're using. Depreciation actually is probably one that I don't see on here. That should be here, and that's actually a contra asset account. Whoa, except I cannot type. Okay. And that would technically be accumulated depreciation, not that that's important. And it's a contra asset. I cheat a lot in this class, and I'm just a terrible accountant. But no, I take depreciation and I use it in the capital account a lot of times as a negative number. Technically wrong, serves its purpose for this class. Most of what we're dealing with in this class, especially in the first chapter, is inventory. Inventory, of course, is an asset, and it's for the most part broken up into raw materials, work in process, and finished goods. Those we'll take care of those for the most part in Chapter 11. For now, just know inventory. Inventory good, right? Those are the things that you're looking to sell. You have a warehouse full of stuff you want to sell. That's your inventory. Now you have capital. Capital, there's two types of capital in this chapter, and we'll get to those in a few slides. It's anything big that you purchase that you're going to depreciate over time. Depreciation is how you make that capital go away, essentially. You buy something, it has a 5-year life. That means you're depreciating about 20% a year. Your equity accounts, we touch common stock a little bit. Usually somebody's issuing stock for cash, right? That's good. That's as good as money. Very seldom paid in capital. Very, very seldom. I don't even know why I put that on here, but it's essentially the same thing as paid in for your purposes. We issue it, we get cash. Retained earnings, again, is kind of your balancing account that makes the balance sheet balance. What's nice about this course is this statement right here. We rarely, if ever, work with liabilities. Totally cuts down on the complexity of life, which is nice. And I just realized I am not plugged in. Interesting. So I'm going to stop. Welcome back. Okay, apparently my microphone was not plugged in, but my computer picked up all that sound. So I might sound a little bit different right now. I might not. Well, we'll see how that goes. Which is the fun part about experimenting with stuff. Yay, experimenting. Okay, so here is what your typical managerial accounting balance sheet looks like. Now in this class, we're going to keep it as simple as possible. This balance sheet itself will get you through 90% of this course. One of the things you'll notice is we have headings: assets, total assets, liabilities and equity, total liabilities and equity. When you're drawing balance sheets and income statements, make sure everything's labeled, it's neat, it looks professional. Those are very important when you look for things like grades, right? Here we have our accounts: cash, inventory, office furniture, manufacturing equipment. Depreciation would be in there if possible. I have a little tool that says draw. I wonder what that's going to do. Oh, sweet. Okay, I don't know how to get rid of that. But maybe I'll come down here and undraw, and oh, okay, that works for me. So if you notice over here, we have total assets. I'm going to go back and play with this now. This is going to be cool. All right. Total assets are equaling liabilities and equity. Very nice. Okay, that means you did it right. Now here you have your common stock, your retained earnings. We're going to get into how you get those numbers. Right now these numbers shouldn't mean a thing to you because I just pulled them out of the air. Important thing here is the formatting, the simplicity of it, right? There's no liabilities, there's no funny accounts receivable, allowance for doubtful accounts. We don't get in any of that junk. But it balances, which is nice. If you're missing a few accounts in the individual problem that you're doing, just leave them out. You're fine. Okay, let's see if I can undraw in, what's the next thing we have? I think it's called horizontal financial statements. Aha, horizontal financial statements. You may or may not have used these in Principles 2, depending on, or not Principles 2, Principles 1, depending on when you had it. We use it pretty extensively in chapters 1 and 11. So you'll learn in this chapter, and then we won't deal with it until December. There'll be snow on the ground. It'll be great, right? Actually, I think we wrap up in late November. So it's an easy way to keep track of transactions. Going back to my drawing tool here, we have event 1, right? Event 1, they're going to give you some text in the book, and they're going to say, for example, we issued $850,000 of common stock for cash. So your common stock goes up, which is an equity account, and your cash goes up, right? So right now, this is your balance sheet. Yeah, I wonder if I can get rid of this. This is ugly. Okay, so that's your balance sheet, and hey, that makes it go away. Nice. And of course, this right here is your income statement. Let's take event 2, right? You got $50,000, cash is going down, right? That's what that parenthesis thing means. And retained earnings is going down. Whoa, and look over here, expenses is going up, net income's going down. That is traditionally a transaction that looks like you spent some money, clearly, on something that's just junk. You bought some supplies for the office. $50,000 worth of supplies, maybe some computers. This is kind of what a typical expense looks like at a company. For 3, now the gist of this chapter, this is going to be some sort of product cost. And we'll get into what product versus period is. Essentially, we spent some money, hence the $140,000 going down, and we bought either raw materials or work in process or something to that effect, which is going to be sitting on our balance sheet. When we sell the inventory, then it hits the income statement. We'll get into that in a little bit. 4, very similar to number 2, so we can skip that. 5 is similar to number 3. Basically, this is what a financial statement looks like, or a horizontal financial statement. These down here are the totals, right? So when we ask you, based on something like this, a typical problem, you would do these. They have 700, columns, rows, etc. You total them at the bottom. This is what becomes your income statement and your balance sheet. So in this situation, we'd say, okay, do a balance sheet, and you would do something that looks exactly like this. Something that looks like this, right? You'd reformat it this way. The numbers come from down here. There's your cash, 305, right? Basically. Piece of cake. It's easy once you get into it after about 10 years. Debits and credits, again, good to know. You may or may not have seen these before. It's not that big a deal if you haven't. There's something called a T account, different than a Mr. T account. What we do with a T account is there's the T, 2 lines. Everything on the left side of the T is called a debit. Everything to the right side of the T is called a credit. What do those words mean? Absolutely nothing. We could call them elephants and donkeys if you wanted. The words are meaningless. What's important is if you're an asset account, let's say cash. Cash is a good asset account, right? And you get some cash in the door. So you just give me a bunch of cash. You're debiting the cash to make it go up. Fair enough. What gets confusing is if you're a liability in an equity account, you would credit those accounts to make those go up. Why? Well, it goes way back to ancient times where they had scrolls and stuff. But essentially, whenever you do something on the debit side of a T account, you have to do something on the credit side of the T account somewhere. So usually when you have an asset, you're touching equity or you're touching a liability. Maybe you're taking a loan out for cash. Maybe you're issuing stock for cash. You do that, you put them on Navy ships, you sell them for 3 months, you come back, you look at the scrolls, and hey, guess what? All your debits equal credits, we're in good shape. Same really thing as the horizontal accounts. This is actually a lot more fun to do on a chalkboard, believe it or not. Okay. There's also a really good Wikipedia page explaining debits and credits, which is all you need to know. Okay, so other financial statements we deal with in this class are the income statement. Income statement's pretty neat. There's, again, we keep it as simple as possible in here. For the most part, we have revenue minus the cost of goods sold is going to equal your gross income. And a lot of what we do is right here. Sorry, yeah, okay. And maybe make a smiley face, right? Because it's the first day of class. Okay. The second very important piece is this selling general administration expense, right? Kind of key piece of it. And that's basically, what is SG&A? Well, for this chapter, anything that's not cost of goods sold is selling general administration. So anything where you're paying a salesperson, SG&A. Anytime you're paying an accountant, that's an administrative expense. Anything generic, that's going to be your general expense. All goes there. Your cost of goods sold is really what we're going to call product costs in a few minutes. Operating income, we're not going to use this chapter, but we will use it in chapter 7. I kind of like this tool. I wonder if I have more tools. I need to check this out. Looks like I have different. Play with that later when I'm not bugging you. Okay, now net income, again, you take your, I wonder if I can write this down, revenue minus expense. Nice. Okay, yeah, it's going to be a long semester, guys. Sorry. Okay. And let me unclick that toolbar, clear all that out, and show you what an actual income statement looks like. Again, this will get you through 90% of the course. You may see something in this class where they'll actually break out an expense like R&D expense or depreciation expense. I'm okay if you do that as well. Some accountants, and you may or may not be an accountant in this class, have to do that. They're compelled to do it. If you lump these expenses here into SG&A, you're not going to be wrong in this class. You'll be wrong when you're an accountant, but what I'm really concerned with is, do you know the difference between COGS and SG&A? So do what you're comfortable with on there. Okay. I guess just some silence for a second. All right. Statement of cash flows. We only use this in chapter 11, or not 11, 7. All it's doing is tracking the movement of cash flows across the company. Cash is very important. Most small businesses fail because of lack of cash flow. You have cash from operations, cash from investing, cash from financing. And the definitions there, we're not going to use it this chapter, and I think I've already talked for 20 minutes, so I'm going to move on real quick. Okay, so here's your quick quiz of the day. What type of accounts are the following? They're either income statement or balance sheet. I will let you work on that on your own. I'm not going to give you the answer, but if you're kind of current, with what I'm talking about, you should be able to answer these pretty easy. Hopefully not. All right. I'm going to pause for a second. I'll see you in a sec. Okay, the manufacturing process. This class is pretty much about manufacturing. Manufacturing is coming back in the US. Cost accounting is very highly geared towards manufacturing. A lot of stuff does, remember there's two types of accounts. There's your manufacturing and then there's your retail, kind of wholesaler type companies. This class focuses on manufacturing. Now there's one specific rule that applies only to manufacturing, and it's an accounting rule. And that is that not all manufacturing expenses are actually expenses. Huh? What? And we'll get there, but for the most part, we differentiate between product costs and period costs. Your product cost is anything that you use in the actual manufacturing process. And your period costs are anything else. And we'll get into the specifics of that. That's what this chapter is about. If it's a product cost, all you're doing is you're sticking it on the balance sheet as an asset. And then when you sell the asset, or sell the inventory, balance sheet is inventory. When you sell the inventory, it goes to cost of goods sold. We'll get into that in a second. What I want to do, I drew this all by myself. This was a blast. This is kind of an overview, Joe's overview of the, what is this, manufacturing process. What we have is we have a couple concepts here. You have upstream costs, you have manufacturing costs, and you have downstream costs. And of course, this is a little river. There's your factory. Nice. And then there's the trees. So you got a lumber mill, right? So what the lumber mill guys do is they got to go find a forest, right? Go find a forest. It's kind of like that Lorax movie, right? Where they cut down all the trees. So they have to find the trees. I'm going to call that research and development. If you're a real stickler, you might call it exploratory costs or whatever, but let's call it research, right? You're trying to figure out where they are, where they grow, what will work fine. Then you cut down the trees and you start sending them over to the factory. La 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 la, they float down the river, and then they get to the factory. Once they get to the factory, we call that a manufacturing cost. There's kind of, you store the logs, and that's your raw material, and you start cutting the logs and the pieces, and you get a bunch of nails and glue, and you glue them together, and suddenly you make chairs, and then your depreciation of your plant, right? Your factory actually gets older after a while. You got to replace equipment. All that is related to manufacturing. The people that are making the chairs, the people supervising the people making the chairs, all manufacturing. Manufacturing folks we are going to call product costs. And then, of course, you float the chairs down the river, hopefully in a barge, right? But you never know. We've done crazier things in our history. We're calling those downstream costs, right? So once it comes off the assembly line, you got to put it in a warehouse to wait for shipping, right? That's called storage. That's downstream cost. You ship it out to your customer, you market it, those are all downstream costs. Everything other than these costs here are called period costs. These costs are called product costs. And they're treated differently. Now finally we get to the chase here, right? Again, product costs are anything related to manufacturing. That's your materials, labor, overhead. You're going to get very used to those three words. I guess it's 4 words because raw is a word, material is a word. Those are your product costs. Other things that we consider product costs, depreciation on a manufacturing plant. And we'll get into a lot later that depreciation on a manufacturing plant is completely different than depreciation of office furniture or a corporate jet or something that's not to deal with manufacturing. Managers of the people manufacturing are product costs. Buying factory machines, product costs, right? Again, everything else is going to be period cost. Upstream, downstream, research and development, you name it. Okay. That pretty much explains that slide. And what do we got over here? Is there anything here that's worth talking about? I think there's a better way of doing that, and that's going to be, oh my, you know what, I'm going to hit pause. Okay, I've gathered my thought for a few seconds, and here I am trying to explain to you the difference between a period cost and a product cost as far as how it's treated on financials. So for your period cost, right, we have two costs here. They're both, I'm going to hit my drawing tool again because it's fun. Yeah, you got $500 for a sales commission. Here you got a $500 bonus for a factory worker. Now, to the layperson, that sounds like the same $500, right? You're paying $500 to an employee, and they go home happy, hopefully, right? Unless they were expecting several $1,000s, then they're not so happy. Here, what happens, right? Your cash gets credited, which means it goes down, and your selling and general and administrative expenses goes up. Okay, that makes sense. A more managerial accounting sort of way of saying it is that you expense your period costs at the time they occurred. Right? Cash goes down, immediately hit the income statement. Boom, boom. On your second issue here, your $500 bonus for a factory worker, that's different. Because it's a factory worker, that's the key. I'll just keep doing this, and I'll play with it a little bit because I'm sure you're... Okay, there we go. You're having fun too, right? Okay, so we got this factory worker. That's the key word here. If it's a factory worker, we think it's a product cost because that's related to manufacturing. That $500 actually goes into inventory along with your raw materials, your direct labor. It doesn't get expensed. So your cash goes down, your inventory goes up, your assets aren't affected at all. That's a little scary. Now, when the inventory is sold at the end of the period, that's when you expense it. You clear out that inventory account, for the most part, clear it out, and you hit cost of goods sold, which is a different expense category than here, right? This here affects gross, gross, and this one here is going to affect net, or more accurately, operating income, which we're not dealing with yet. All right. So that's my product versus period. So what is going on here? Okay, here is kind of a horizontal financial statement in action, which is nice, right? So here we're paying a $500 sales commission. Let's get my drawing thing out again, right? $500 sales commission. So it's a salesperson, you should be thinking period cost. Cash goes down, retained earnings goes down. I am going to tell you in about 10 chapters that doesn't happen till the end of the period, but for now, retained earnings goes down. Selling general administrative expenses goes up. Your net income goes down, right? It's expensed right away because it's a period cost. Now here you got a $500 for your manufacturing employee, right? Manufacturing employee, product cost. Real simple transaction. Cash goes down, inventory goes up. And then you got a couple other things that are happening here that I just did for fun. You got your $1,000 of raw materials going in inventory, $1,000 in overhead going into inventory. Chapter 11, we break the inventory into 3 different categories. For now, I'll call it inventory. For 5 and 6, we're going to get into in about 5 to 10 slides. But pay attention for a second here on how those are treated differently. 5 is depreciation. 6 is depreciation. So they should look the same on the horizontal statements, right? They don't. Your depreciation of a factory is your product cost. So your capital goes down, your inventory goes up. Your depreciation on the corporate jet, because it's a corporate jet, and it says Jeb there, I apologize for that. Corporate, everybody needs a corporate Jeb lying around. So that should say jet. And depreciation on that, what happens is your capital, oh, you know what? No, I can't change it, darn it. Oh. Your capital goes down, your SG&A goes up, expensed right away, non-manufacturing. Here, if you notice, you sold all 1,000 chairs that you made. That's an important distinction. If you only sold some of the chairs, you'd have an inventory balance. Because you sold all of the chairs, this balance goes down to 0. Right? So your ending inventory balance this month is 0. And it's hitting COGS. And then here's your revenue, right? Because you sold something, theoretically they pay you, hopefully. Or at least they committed to pay you. There's that. There's your revenue. There's a total mess. So I am going to clear this out, and I'm going to let you stare at it for a little bit. If everything goes well, both these raw slides and this recorded nightmare version that I'm making right now will be available to you on Blackboard shortly, hopefully before the class starts. Okay. Let's see. I think we already kind of mentioned these. We just talked about product and period. Now we have direct and indirect costs. Now, usually these are all product costs. Not always, but for the most part. A direct cost you can trace directly to the cost of a product, right? Direct materials, direct labor. It takes 600 pounds of steel to make a car. There you go. You can trace it directly to it. Easy to do. Your indirect costs, for the most part, we call overhead in this class. Now that would be like, cleaning supplies. Think about how many squirts of bleach do you need to clean your bathroom at home. I don't know, 5, 10, depends how dirty it is, right? Over time, the average out. Well, in manufacturing, same thing with cleaning supplies, electricity used per unit for a product, how much rent was for a product. Well, it depends on how many products you make. It averages out, so you do an estimate, and the term is applied. Again, we get into what applied overhead means later on in the course, because there is a reconciliation that happens at the very end, yada yada yada. For now, just know that anything you have to estimate, or if it's just such a pain in the neck to get the direct cost of a product, you estimate it because it's more cost efficient. Those are indirect costs. Okay, now we get into depreciation. Okay, so what is depreciation? Initially, you purchase an asset, say factory equipment. It could be office furniture, it could be airplane, it could be buildings. Usually something big and expensive that has a long-term useful life, and theoretically it's going to generate you some revenue later on down the street. And that's your fixed assets. It's important to recover that cost, right, over its useful life. So you buy a house and you have a 30-year useful life on it. Every year you take 1/30 of the cost of that asset and you expense it essentially by depreciating it. Now, there's 3 depreciation accounts we use in this course. We use depreciation expense. Now, depreciation expense we're using for your period cost expenses. So a corporate airplane, right? Corporate airplane's not used in manufacturing at all. So when you depreciate it, you put it right into SG&A. Inventory is the other thing, and that is for your product costs. So you have a factory. You can say, let's go buy a factory, and you buy a factory. The cost of the factory goes in the capital. As you depreciate the factory, the depreciation part goes into inventory, just like raw materials. It's technically part of overhead, but just like, direct materials, direct labor, direct overhead, your depreciation is part of that inventory. When you sell the individual products, that portion that is attributed to inventory goes into something called depreciation expense. No, it doesn't. I just lied. It goes into COGS. Sorry. Long day. Cumulative depreciation is your contra asset account. And what your cumulative depreciation is doing is it's lowering the value of that capital on the balance sheet. And that's probably more than you need to know. Okay. So what do we have here? Here is what a typical depreciation of a manufacturing-related asset looks like. Okay, so we have event number 1. I'm going to go grab my handy drawing tool. We're purchasing inventory, right? Cash goes down, right? Because we're spending money. Capital goes up. So we have this big honking asset sitting on there, right? $10,000. And it's probably going to have, yep, I did it right. I said there's a 10-year useful life, so we got $1,000 annual depreciation. Makes sense. What happens here, because it's a manufacturing-related asset, is your inventory goes up and your cumulative depreciation goes down. contra asset. When you sell the product, let's say that the only cost of the product was this depreciation, which is a little bit unrealistic, but hey, we're doing an example here, right? You sell the product, your inventory goes away, your retained earnings goes down, your cost of goods sold goes up, right? And then of course you're saving the revenue. Okay, that's simple. Let's compare it to this other depreciation. I guess I have to unclick my pencil, and there we go. Okay, so for here, this is more standard. So if you're a non-manufacturing company, or if it's a non-manufacturing depreciation, right, you purchase the equipment, same purchase, cash goes down, capital goes up, no problem. You'll also see in the book they split out the capital. They'll call it airplane, they'll call it something else, that's fine to do as well. I just try to keep everything on one slide. So your year one depreciation here, what happens, your cumulative depreciation goes down, and your depreciation expense, which I already told you a few slides ago you could call SG&A if you want, goes down. You're expensing it immediately. Okay, so then what's next? I do have some recommended practice problems, which I'm not going to run you through quite yet, mainly because you really need to sit here and stare at it and, you know, rub your head and go, I don't know what this guy's talking about, he's crazy, do all that stuff. Page 8-9 of the textbook. No, I'm sorry, that's page 8 through 9. Sorry, page 9 of the textbook is a great place to, and let's do this so that I don't make that mistake later. Okay, page 8 and 9 of the textbook, great problem. There's also the self-study problem on pages 25 to 26. And they take you through this entire process. And what's nice is the answers are right there. So you do it wrong, you can look at the answer and you go, oh, I did it wrong and here's why. Oh, okay. So that'll be fun. Okay, now we have pricing, right? So we talked about all of these crazy costs, right? That should be confusing as hell to you right now, as it should be. We're day one, we're lecture one. I'm talking like I'm in Jersey, I've had a lot of coffee, right? So we got product cost, period, cost direct, cost indirect, cost, yeah. Ignore all that for pricing. Just ignore all of those for pricing, right? What you got to remember as a business person is that all of those costs have to be recovered when you sell a product. And so all pricing is how much should you charge for something, right? What price do you set something at? Now your typical example of that, right? You have a product cost of $500 per unit. You have a period cost of $500 per unit. And you want to sell it at a 20% markup. Usually what they'll say is of total cost. And I'm going to actually type that down, because they may not say that. They could say 20% markup of product cost. They could say whatever they want to say. But typically we do in this book a cost plus pricing scheme, which means you take the cost, you add 20%. Now there's a couple things people do wrong, right? Sometimes they take the $500. They forget about the other $500, and they take that and add 20% to it, and they get the wrong answer. And if you do that in real life, you go out of business, and your creditors come and take away your house, and you're just left broke, and with the clothes on your back. So we don't want that to happen to you. Now, other things people do is they take the $500, they take the other $500, and they say we have $1,000, and they multiply it by 20%, and they say that's $200, so I'll sell it for $200. That's a mistake, right? Because now you're losing $800 per unit. So you need to recover the $1,000 cost plus the 20% markup. Now, how you do that mathematically, you take the $1,000 times the 1.20, and that'll give you $1,200, which is how much you'd want to charge for it. Below that, I kind of have a little bit more of a description, right? You take the 500 plus the 500 times 20%. That should give you 200. Right? And then you add up the original cost and you get 1,200. Either way to do it. I always find there's 3 or 4 students that don't know this trick. I learned it back in the restaurant days where you had to like calculate how much somebody's tax was really quickly, or their total bill, like when you're cashiering or something, and it's like, okay, it's $1 plus 8% tax. Well, that means it's going to be $1.08. How do you figure that out? Well, you take $1 times 1.08. Boom, done. Saves you time. That sort of thing. Okay, what do we have here? This is just to remind you that if you don't sell everything, you're going to have an ending inventory balance. And that's good, and that's healthy. So take a look at this in your spare time, which of course you're going to have plenty of, right? Take a look at this, make sure this makes sense to you. Now here we have just in time. I think these just in time problems are kind of evil, which is why I love giving them. There's going to be one on the homework that's like this. If I don't cover it, nobody gets it. It's weird how that works. Really, so what the goal of just in time is to minimize your inventory holding costs. And all your holding costs are how much to hold the inventory, right? It's got to sit around the warehouse. You got to pay for the warehouse. You got to have more than you need. You always got to be careful when you're manufacturing or selling anything for stockouts, right? If 500 people show up and say, "Hey, Joe, I want to buy your chair," and I say I only have 200 of them, 300 of those people are going to go next door and buy chairs, and I'm going to lose the sales. On the other side of that, there's the opportunity cost, right? If I'm holding 600 chairs and 500 people buy them, I have to pay for an extra 100 chairs that are never going to get sold. So just in time tries to get around some of that. So what you have is you have exercise 115A on page 33. It's Lee Pet Supplies. And they structure the problem in the most confusing way humanly possible, right? So they say currently they have, this complicated business, yada, 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 and their inventory holding costs are about $21,000 a year. Sounds like a big number. And they pay 9% on finance charges. Typically what companies do is they borrow money to hold the inventory, right? So they never actually pay that $21,000 off. That means annually they're paying $1,890 in interest. And this is a calculation, right? Oh, hold on, let's do this. That $1,890 is something we calculated by taking the 21,000 times the 9. Now someone told them, someone crazy, that if they went to a just-in-time inventory model, they'd only need to carry $4,000. Nice, right? But what's important to that is they're only paying interest on $4,000. Right? So one of the things you wouldn't know about at this point in your career is that these numbers don't mean anything right there. I'll just cross them out. What's important is these numbers, the difference in interest payments. And that difference, when you subtract it to, is $1,530. The other thing the problem says is, in addition to that, there's a $2,500 worth of cost savings. Okay, well that's nice, right? Expense reduction. When you're actually working for a living, beware of expense reductions. They never seem to materialize, but they'll always sell you on them. Okay, that's just me being cynical, but it happens. Okay, so you end up with 40/30 of total savings at the end, which is the answer they're looking for. Okay. Pretty easy, right? You take the interest savings, you take the expense reduction. If you don't know what you're doing, what I expect you to do, what I did the first time I did this problem was I tried to do something with this 21,000 and the 4,000, forgetting that we never actually pay it. Generally, this is a little more complicated than anything you'll see on a test, but I like to torture you with your homework. I figure if you get really good in the homeworks, the test should be easy. Okay, now we have fraud. We teach fraud in several areas in the curriculum. The big thing with fraud is we have this thing called the fraud triangle, and I'm going to go up here and just name it the fraud triangle. Right? It doesn't have to be is that an isosceles triangle? I don't remember my geometry. Sorry guys, it's been 30 years. Yeah, I guess it's an equilateral. Yeah, let's call it equilateral. Anyway, doesn't matter. You got a triangle. 3 things must be present for a fraud to take place. First thing is you need an opportunity to commit fraud. Now, accountants, for the most part, are really good at eliminating the opportunity to commit fraud. We install controls, segregation of duties, all these types of things, right? Passwords, logins. You take away the opportunity, nobody can commit fraud. The other thing is pressure. Now, pressure can be internal or external. Internal pressure would be wanting to keep up with the Joneses type thing. External would be your boss saying, if you don't make these numbers look like I want them to look like, you're going to lose your job. They exist. And in rationalization means, you're telling yourself that it's okay. Everybody else is doing it. I'm only stealing a little bit. Those sorts of things. Pressure and rationalization, you can really mitigate that risk through corporate culture, training, those sorts of things. Opportunity is a lot easier to kind of get your arms around. Fun thing about accounting, and actually one of the reasons why I got into accounting, if not the, actually no, it's probably one or two reasons. One was because I was day trading. The other was because I found all these companies were committing a lot of massive fraud. And this brand new law came out called Sarbanes-Oxley Act. And what it does is it actually legislates that management is accountable for financial information and controls. And they can go to jail for it. Whereas before, when a lot of these frauds happened, turn of the century, everybody said, oh, well, we're CEOs, we're not actual accountants. We don't know how this works. Now the law says, well, if you're a CEO, you better be paying attention. And if you're on the board of directors, you better be paying attention. You better be competent. Back in the day, football players were on boards of directors because, oh, they're celebrities, let's have the football players in here. And it was generally a bad idea because they couldn't control anything, they didn't know what was going on. So anyway, now that there's these hard penalties, corporations are taking their government's responsibilities slightly more seriously. Other little things they have, like requiring codes of ethics for publicly traded companies, hotlines, all those things like that. We got a lot of pushback when it first came out from companies. Oh, it's going to cost all this money. When I was implementing this back in the day, for the first time, nobody even knew what a controller or risk was. They had no idea. It's really changed the corporate landscape in this country, which is great. Here I've got a sample test question. It's very nice. You will like it very much. And in here I recommend some other problems to do. Now, of these other problems, 1-3A is the answer there, so make sure you do the problem before looking at the answer clearly. There's 121A in the answer, right? Again, make sure you can do the problem before you get the answer. And don't panic if you get I'm going to pick a random number, like number 4 wrong and everything else is right. Don't be like, oh, I'm terrible. There's partial credit in this world. And again, there's 115B, which is another fancy just-in-time problem. Now, ETC 1-7, I'm going to try to do as a different screencast. It won't be today because I've got to be somewhere in 5 minutes and it's an hour away. But what I will do for you guys is I will create another screencast. And really what I'm trying to show you is how to create a spreadsheet. Well, that's it for today. That is chapter 1. That's I thought this would be a 5-minute video, and it's now at 47 minutes. So I gotta go figure out how to edit, and which I don't know if I have the permissions to do that. It'll be fun, and then of course adding captions, all kinds of fun, good, and teacherly type things. Hopefully this will be posted by first day of class. Hopefully you're not too confused. I'm going to give you a lot of different resources that are somewhat redundant. Essentially in this class, if you can do the homework, you'll be fine. Have a great day and enjoy your week. Bye.